Hi everyone, welcome back to Saheb Academy. Today in this 8th video of redemption of preference shares chapter, we are going to solve this practical question number 3 from the ICAI study material Trinity Limited, which is 6th problem of our series. But this problem is a bit complicated because here we have got final accounts adjustment, that is we have to redraft the balance sheet, because see in this question what has happened is here we have been given previous year balance sheet, okay, and we are doing redemption at the year end. Yeah, in this question at the year end we are doing the redemption and we don't have the latest data. The balance sheet has been given to us which is of the previous year, right? So that is why we have to take this balance sheet and change some data. We just have to redraft it. Okay, that's the final accounts adjustment. And we have also got bonus issue in this question. Yeah, if you're doing bonus chapter, then this question is very good for you, because in exam this sort of question can come. Yeah, redemption of preference shares plus final accounts plus bonus issue. Okay, so now before watching this video, please make sure you know proper accounting treatment and the concept regarding redemption of preference shares as well as the bonus issue. If you don't know, then please go back and watch the videos. Okay, I have a playlist on the bonus issue as well. All right, now see here, Trinity Limited gives you the following information as at 31st March 2021. Okay, a balance sheet has been provided to us and the date is 31st March 2021. You can also say 31st March 2001, it's up to you. So see here, property, plant and equipment, gross block 3 lakh less accumulated depreciation 1 lakh, so that's 2 lakh property, plant and equipment. And then we have investments 1 lakh, inventory 45,000, trade receivables 25,000, cash and bank balances 50,000. So these are the total assets of Trinity Limited. And then we have equity and liabilities, share capital authorized 10,000, 10% redeemable preference shares of rupees 10 each. Okay, that's authorized capital, leave the authorized. Issued, subscribed and paid up capital 10,000, 10% redeemable preference shares. Okay, 10,000 preference shares, number of preference shares of rupees 10 each, 1 lakh. 1 lakh is the preference share capital, and this is what we have to redeem. Clear? Easy. 10,000 equity shares of rupees 10 each, 1 lakh, that's the equity share capital. And then see the reserves and surplus. General reserve 1,20,000, which is a free reserve. You can use that for creation of CRR as well as to write off premium on redemption. You know that it's a free reserve, right? And for bonus issue also you can use general reserve. And then we have securities premium, 70,000. Now securities premium you cannot use according to the Companies Act for what? You cannot use it for writing of the premium on redemption or creation of CRR. No, you can only use securities premium for what? Here in this chapter you can use right now in this question only for bonus issue. Okay, fine. And then see profit and loss account, which is a free reserve. Now the same thing applies as I said for the general reserve, which is you can make CRR with profit and loss as well as write off the premium on redemption. And the third thing is you can also do bonus issue from profit and loss. Is that clear? 18,500. And then you have current liabilities and provisions 11,500. So these were the total equity and liabilities of the Trinity Limited. Simple, easy. Now let's see what additional information is saying regarding this question. Okay, the balance sheet date here was what? 31st March 2021. But see in this question, redemption is happening in the current year, and the current year is for the year ended. Yeah, the current year ended 31st March 2022. You see, this balance sheet is what? Is previous year's balance sheet, right? All these figures are outdated. So now what you have to do? Final accounts will come into the picture. You have to redraft this balance sheet. You have to bring these figures to which date? To this date, 31st March 2022. Then only you can proceed ahead with the redemption. Is that clear? So let's see how you will redraft the balance sheet. It's really simple. For the year ended 31st March 2022, the company made a net profit of 35,000 after providing 20,000 depreciation. Okay, what are they saying? Net profit of 35,000. Okay, so you will not do something about the depreciation in the profit. No, this 35,000 has come after charging the depreciation. So what you're going to do about this in the balance sheet? In the balance sheet, what you're going to do? See, it's really simple. You are just going to increase the profit and loss by 35,000. Okay, plus 35,000. Simple. Yes. Then see, they are saying the following additional information is available with regard to company's operation. The preference dividend for the year ended 31st March 2022 was paid. Okay, so if preference dividend is given out, what happens? Because of preference dividend, two impacts are there. The first is, now in profit also there was an impact, isn't it? Cash impact is there because of profit, but let's see the cash impact at last. Okay, not right now. We will take the cash as a balancing figure. Okay, as a balancing figure. Don't worry, it's really simple. Let's talk about the dividend. What happens because of preference dividend? When preference dividend are given out, of course, cash decreases in the company, negative impact on cash, and negative impact on profit. Yeah, profit goes out of the, the company, right? The reserve. So because of that, again, what will happen? First, let's calculate how much is the preference dividend, right? What's the percentage? 10%, right? So 10% on what? 10% on 1 lakh. So 1 lakh into 10%, of course, we all know it's 10,000, but I just wanted to show. Okay, it looks good. Right? So 10,000. So 10,000 is the dividend. Because of dividend, what happens? Because of dividend, profit and loss will decrease. Of course, profits are given out now. So minus 10,000. Simple? Yeah, easy. 18,500 plus 35,000 minus 10,000. And the second effect is on cash, but we will not touch the cash right now. We will take the cash as a balancing figure at last. Okay, right. Next, what happens? See, they are saying, second point, except cash and bank balances, other current assets and current liabilities as on 31st March 2022 was the same as on 31st March 2021. They are saying nothing has been changed except cash and bank balance. They are saying nothing has been changed. Nothing means current asset and current liabilities have not changed. Yeah. What are the current asset and current liabilities? Investment, inventory, trade receivables. Yeah. These things have not changed. They are saying, and they are saying, current liabilities have also not changed. It's the same only. So this will be 11,500 only. Okay. Let me just write that 11,500, and then trade receivable 25,000 only. No change in that. And then inventory, no change, 45,000. Now in investment there is a change. Okay, they are saying there is not a change. Yeah, they are saying there is not a change, right? But there is a change. Let me tell you. See here in the 6th point. Yeah, after that they are saying investment were sold at 90% of cost on 31st March 2022. Investment were sold at how much? At 90% of cost. Yeah. What is the cost of investment? The cost of investment is 1 lakh. 90% means it was sold at 90,000. Since it was sold, so nothing will be there. This will become 0, right? It was sold at how much? 1 lakh is the cost. It was sold at 90%, 0.90. So it was sold at 90,000. If it is sold at 90,000, then of course you can clearly understand, you can clearly understand there is a loss. How much loss is there? 1 lakh was the cost. You have sold for 90, then 10,000 is the loss. So that loss you have to consider, and that will affect your profit and loss, isn't it? So that is why loss on sale of investment will also be considered over here, minus 10,000. Is it clear? Simple. And then of course there is a change in property, plant and equipment also, isn't it? See, property, plant and equipment was 3 lakh, right? It was 3 lakh. And then what happened? How much depreciation was there? Depreciation of 20,000. Yeah. So this depreciation, what you will do in this accumulated depreciation, you will add that depreciation, right? This will become 1,20,000. From 1 lakh it will become 1,20,000. So the new figure of property, plant and equipment, the net figure will be what? It will be 1,80,000, isn't it? 1,80,000. See, 3 lakh minus 1,20,000, that is 1,80,000. 1,80,000. Okay. Yes. And then what else is there? Yeah, redeemable preference shares. Yeah, we are redrafting the balance sheet before the redemption and before the bonus. Okay, so this preference share, let's keep it as it is only. There is no change because the redemption has not happened. We need the balance sheet before redemption. Okay, on which date? On 31st March 2022. Okay, so this we had, and then equity share also same. There is no change. Okay, no change, right? And then general reserve and securities premium, no change. It's same only. Nothing has happened over here. 70,000. Clear? Now profit. Did we consider all the impact on profit? What happened to the profit? Plus 35. That's the net profit. Minus dividend. Minus loss on sale of investment. Yes, everything has been considered. So what's the profit figure? Let's calculate the profit figure. The book value was 18,500. Minus 10,000 minus 10,000 plus 35,000, sorry I missed that, that's equal to 33,500. 33,500 is the profit and loss before redemption. Okay, so that's the figure. Okay, let me just write it over here, 33,500. Now what you will do, how will you calculate the cash balance? We have redrafted the whole balance sheet except what? Cash and bank balance, right? So that will take as a balancing figure. See, it's really simple. How will you do it? Let's make a sum of first equity and liabilities. Okay, so see here how much it is. See here, 1 lakh preference share capital, 1 lakh equity share capital, and then 1,20,000 we have what? General reserve, and then 70,000 securities premium, and then we have profit of how much? 33,500, and then we have 11,500 of current liabilities and provisions. Okay, so that's equal to 4,35,000. 4,35,000. Okay, so here also it should be 4,35,000, isn't it? Do you have any doubt in this? Of course not. You all know asset is equal to liabilities plus capital. Yeah, yes. So 4,35,000, right? So now as a balancing figure, just calculate the cash balance. Okay, so 4,35,000 minus 25,000, which is the trade receivables, minus 45,000, which is the inventory, and then there are no investments because we have sold them, and then we have to subtract the property, plant and equipment, 1,80,000. That gives you 1,85,000 as the cash figure. How much? 1,85,000. Okay, so now what you have to verify at this point, you have completed the final account adjustment, that is you have redrafted the balance sheet, right? You have redrafted the balance sheet. After redrafting the balance sheet, what you need to check, you need to check whether you have enough free reserves. Yeah, enough reserves for a redemption of preference shares if you are not making a fresh issue. In this question you are not making a fresh issue. Question has not said anything about the fresh issue, right? See, it's really simple. How do you redeem the preference shares? There are two point of view in doing redemption of preference share. The first is what? There are two angles. The first is legal compliance, section 55. Section 55 means you have to do replacement of capital. Replacement of capital happens only in two ways. What two ways? You have to make either a fresh issue of equity shares, or what you have to do, you have to create CRR, capital redemption reserve, out of free reserves only, right? These two options only you have. And then there is another aspect, another point of view is you should have enough cash. If you don't have cash, you cannot do redemption of preference shares. So how will you check whether you have enough cash or not? It's really simple. Just check how much you have to redeem. 1 lakh, right? 1,10,000 premium. So in total 1,10,000. Do you have enough cash? Of course you have enough cash. But previously you didn't have enough cash. You had only 50,000. After factoring in everything, all the final account adjustment, and then you know, the company also sold investment. Why did they sell investment? To arrange the cash. That's what happens, you know. Whenever investments are sold or any other assets are sold, or even the company can also take a loan just to manage the cash. Okay, that can also happen. Okay, so all that is cash management. There are two aspects. First is section 55, legal compliance. Okay, and then there is cash management. Cash management is this selling of the investment, taking a loan and all that. Is that clear? Simple. So we are done with the final account adjustment. Now let's understand how we are going to proceed with the redemption of preference shares. Okay, the main working note which we prepared. Which one is that? This one. See here. This equation, you remember, preference share capital plus premium is equal to preference share holder, right? This is the face value. This is the extra thing that we are going to pay, right? Because the question has said, see here, the question has said the company redeemed the preference shares at a premium of 10% extra. So that 10% extra is a loss for the company. From the point of view of the company, it's a loss, right? So see, 1 lakh is the face value, isn't it? 1 lakh is the face value. See here, 1 lakh, right? So that 1 lakh, and then 10% on that, that's the premium extra you are paying. So total 1,10,000 you are paying. So first, what is our step in journal entry? First, we will pass the due entry. And then the second step is writing off the premium on redemption. Premium on redemption, isn't it? So how will you write off the premium on redemption? You can only use free reserves for that. You will only use free reserves for that. You cannot use securities premium. Previously, you could use securities premium, but after the amendment, you cannot. Right. So, you know, profit and loss will utilize. Now see what the study material has done. Study material has taken an easy way out. Yeah. See, why did we do all this? Why did we do all these final account adjustment? Because to know the latest information about reserves and surplus. And mostly if you see, all the adjustments impacted where it impacted in profit and loss, right? So just say for example, we got this question in exam, okay, and we don't touch the profit and loss. We don't touch the profit loss at all. We directly see whether we have enough money in any other free reserve. For example, general reserve. We have general reserve over here which has 1,20,000. It has enough balance now. It has enough balance. See how much we need? 1,10,000 to create the CRR, right? We need only 1,10,000. So if we have enough money in GR, then you don't need to go in all this hassle. Directly, just take the money out of general reserve and yeah, finish off. That's all you have to do. And that's what ICAI has done. They have taken an easy way out. See here. Let me just show you the journal entries. In journal entries, if you see general reserve to premium on redemption of preference shares, they have utilized general reserve for premium on redemption. For creation of CRR also, they have utilized general reserve. So this way, what happened? This way it becomes really easy, right? But for example, let's just say in exam what happens is they don't give you general reserve. They give you only profit and loss. Then what will you do? So that is why please do not take easy way out. Solve the entire problem, understand the whole mechanism, how things work, then only you will have a better command on this chapter. That is why I'm solving this question alternatively, okay? Not exactly what the ICAI has done, but I'm utilizing profit and loss first, not general reserve, okay? That way you will have the whole understanding regarding this, okay? So see here, what have I done? To write off the premium on redemption, I'm utilizing profit and loss, okay? Now, you can also utilize GR also, general reserve also. There is no rule regarding that. You just have to utilize free reserves. Profit and loss or general reserve, it doesn't matter. Whichever you want, you can utilize. It's just that you should have enough balance in that. Is that clear? To stay on the safe side, what the ICAI has done, you know, to make it easy for the student, they have just utilized general reserve. It becomes easy now, right? So, let's see the hard way, okay? So, we are utilizing profit and loss over here by 10,000 to write off the premium on redemption. Okay, fine. So how much do we have in profit and loss? We have 33,500. So from 33,500, if we utilize 10,000 for writing of premium on redemption, then we still have how much left? We still have 23,500 left, isn't it? 33,500 we had after doing all that final account adjustment. We utilized 10,000 for premium on redemption. We are left with 23,500 in profit and loss. Now that 23,500 we can utilize to create CRR. Now the question is not saying anything about fresh issue, so we will not do anything about fresh issue, okay? So we'll directly do all from free reserves only. You know now, section 55, this is section 55. Face value can only replace face value, or what you can do, you can create CRR. Yeah, this is section 55. All right. First, I utilize profit and loss 23,500 completely. Profit and loss finish. Yeah. And then GR is there. GR, we have how much in GR? In GR, in general reserve, we have 1,20,000. So from GR, I have taken the balance. Yeah. If 23,500 I have taken from PNL, then how much do I need? I need 1 lakh now in total. So 23,500 minus 1 lakh. The balance I have taken out from GR, 76,500. Easy, understood? Okay. So what will happen in the journal entry? Profit and loss will decrease, GR will decrease. You will have to debit these guys and you will have to credit the CRR. This new reserve is coming into the picture. To create the reserve, what you have to do? Reserves have credit balance. To create, you will have to credit the CRR account. We'll see the journal entries, don't worry. Okay, here I'm just showing the rough working. Okay, and then what will happen? The fourth is this fresh issue, but fresh issue is not there in the question. Entirely we have created the CRR. Fifth thing is paying off the preference shareholder, right? Due entry, writing off the premium on redemption, the loss which the company has incurred, and then, you know, creation of CRR or transfer of CRR, you can say, and then fresh issue which is not there, and then paying off the preference shareholders. Okay, these are the 5 steps that you follow for doing redemption of preference shares. And then there is also investment entry in this question, yeah, because investments were sold now. That is just to manage the cash. Don't worry, it's not connected. This investment thing is not connected over here. This is section 55. Okay, just to arrange the cash, investments have been sold. Don't connect like that. Okay, don't think that here somewhere investment will come. No, it will not come. There is no relation between here and you know, the cash management. No, that's separate. Cash management is separate, and then section 55 is separate. Replacement of capital is separate. Is that clear? Right. So now let's see the journal entries. Now here we have the journal entries. Let's understand how to pass them. It's really simple and straightforward. All you have to do is just follow the equation. Yeah, this working which we have done now. First, the due entry, the second is writing off the premium on redemption, the third is creation of CRR, and then fourth is fresh issue of equity shares. But since in this question there is no fresh issue, so we are going to skip this, the fourth step. And then the fifth entry is paying off the preference shareholders. That's all. Okay, 5 entries related with redemption of preference shares. And then in the question there can be extra entries. It depends from question to question, so you have to see the question properly. Now in this question what happened, first we had final account adjustment, we had to redraft the balance sheet. Okay, that's done. And then second thing is you have to see whether you have enough cash or not, enough cash, enough reserves, right? So we had enough reserves after the redrafting, but the cash we did not have. Yeah, enough cash we did not have. So the question told us exactly what to do about that. Is to see here, to meet the cash requirements of redemption, the company sold investments. Investments were sold at 90% of cost on 31st March 2022. After this we will have cash, right? So this entry you have to pass first before going ahead with the redemption process. Yeah, first you have to do the cash management properly. Okay, this is the cash management. So what was the cost of investment? You all know, we have seen this. Investment cost was how much? 1 lakh, right? So 1 lakh was the cost. You have sold at 90% of cost. That means you have sold at 90,000. You have received 90,000, but the investments have gone. What is the cost of investment? 1 lakh. So what's the loss? 10,000, isn't it? So that journal entry you have to pass. So it's a really simple and straightforward journal entry. See here, sale of investment, bank account debit. You have received 90,000. Yes, and then a loss has been incurred of how much? 10,000. What do you do with losses? You have to debit the losses, yeah, to record them. And in modern rules, what you can say that it's an invisible expense really. So it is increasing, you have to debit that, right? And the investment is gone, you don't have the investments, right? Asset is decreased, so you have to credit 1 lakh. Fine, simple. And then you have to start with the redemption process. Now, how will you start with the redemption process? Really simple, go to the equation. What's the first entry? Due entry. Preference share capital account debit, premium on redemption account debit, and then preference shareholders account credit. What is the logic of this? Really simple. What is happening over here? Here the company is cancelling the preference share capital because we are doing redemption and we are paying 10% extra. So this 10% extra is loss to the company. So we have to debit that, debit all losses, right? And then preference shareholder, why is it being credited? Because as a company we are accepting, we have to pay 1,10,000 to preference shareholders. So a personal liability is being created. Liability is increasing to preference shareholders. Is that clear? That's the logic of this entry. See here, 10% preference share capital account debit, 1 lakh. Capital has credit balance. We are debiting and cancelling it off. And then premium on redemption of preference shares account debit, 10,000. Yeah, 1,10,000. Yes, okay. So this is a loss. We have debited and recorded that. And then to preference shareholders account credit. We have to pay money to preference shareholders. Okay, the liability is being increased, so we have to credit that. Clear? Easy. The second entry is what you have to do. You have to write off this premium on redemption. See, this premium on redemption we debited over here. We recorded a loss, 10,000 extra we are paying, right? Now that loss has to be written off. How do you write off the losses? By using up the free reserves, right? Here you can only use free reserve. You cannot use securities premium, okay, or any other capital reserve and all. You can only use what? Free reserve, P&L, general reserve, dividend equalization fund. All right. So 10,000 will be written off by P&L. So P&L will decrease by 10,000. If P&L is decreasing by 10,000, that means you have to debit. Yeah, because P&L has credit balance. If you are utilizing it, then you have to debit that. Profit and loss account debit to premium on redemption of preference shares account 10,000, 10,000. Okay, here premium on redemption of preference share was debited in this entry, in the due entry. Now you are making an equal credit and cancelling it off. You are writing it off. Okay, debit equal to credit, cancelled. Clear? Simple. And then what you have to do, you have to create CRR, capital redemption reserve, right? We have already done the working and everything, yeah, regarding the numbers. Now you just have to pass the general entries. How will you pass the general entry of this? Really simple. You're utilizing profit and loss and general reserve. So you have to debit them. Reserves have credit balance. If you're utilizing the reserves, then you will have to debit them. They are decreasing. Profit and loss account debit, general reserve account debit. By what amount? By this amount, 23,500, 76,500. In total it is 1 lakh. So that 1 lakh will go where? In capital redemption reserve. This new reserve will come into the picture to capital redemption reserve account, 1 lakh. Simple. You got this? Easy. After this, what you have to do? After this, you have to what? Do fresh issue. But in this question, there is no fresh issue. So leave that. Jump directly to the fifth entry, that is paying off the preference shareholders. Everything is done now. Due entry, writing of the premium redemption, creation of CRR. You have complied with section 55 and we also have enough cash, right? We have sold the investment and made the arrangement for cash. So now the last step is what? You just have to pay off the people, the preference shareholders. How much? 1,10,000. So how will you pay? Really simple. Just look at the first entry. In the first entry you accepted, you have to pay to preference shareholders account. Yeah, here liability increased. Now at the end, what's happening? You're paying off. If you're paying off, then of course the liability will decrease. So here it was credited in the first entry, liability was increasing. Now you have to debit and decrease the liability. Preference shareholders account debit. Okay, before it was credited, now you are making an equal debit, liability is being cancelled and money is paid to preference shareholders, to bank account 1,10,000. Preference shareholders account debit to bank account 1,10,000. Clear? Simple and straightforward. So redemption is over. Entire thing regarding redemption is over. But is the question over? Of course not. In the question they have said, see here in the fourth point, the company issued bonus shares in the ratio of 1 share for every 1 equity share held as on 31st March 2022. So a bonus issue is happening. Let's just discuss the basic concept of bonus. What is bonus? Bonus is nothing but converting reserves and surplus of company into equity share capital, right? And this happens in a ratio. A proper ratio will be decided by the company. And there are two types of bonus. Okay, first is issuing fully paid up bonus shares, and the second is making the partly paid up shares into fully paid up. Okay, this is also called as bonus call, but this is not there over here. Here they are talking about what? The company issued bonus shares in the ratio of 1 share for every equity share held. If you have 1 share, then 1 additional share will be given to you free of cost. Okay, that's what it's being said over here. 1:1 ratio. Okay, 100% bonus is being given. So two types of bonus are there. First is issuing fully paid up bonus share, and the second is bonus call. Here they are talking about fully paid up bonus shares. Now what are the rules regarding fully paid up bonus shares? Fully paid up bonus shares means what? You are issuing fully paid up bonus shares to the existing shareholders free of cost in some ratio, and that ratio is here 100%. Okay, we'll discuss about that. It's really simple. The main thing regarding this is that you have to utilize the reserves. Which reserves you can utilize for this first type of bonus, issuing fully paid up bonus shares? You can utilize, and there is a proper sequence. You cannot directly utilize free reserve or like that. No. First, you can only utilize CRR, capital redemption reserve. The second, you can utilize securities premium, which is realized in cash. And then you can utilize capital reserve realized in cash. And then fourth is free reserve. Okay, free reserve means general reserve, profit and loss, dividend equalization fund. Okay, all these reserves. So this is the sequence you have to follow: CRR, SP, CR, and then free reserves. Is it clear? This is very important. But now in this question, what do we have? What reserves do we have? Do we have profit and loss? No. First, how will you check? First, you will check whether you have CRR or not, because that's a sequence now for bonus. First, check whether you have CRR or not. Do we have CRR in this question? In the question, it was not there, but after doing the solution, we came to know, we had to create CRR, and we created CRR of 1 lakh. So we have 1 lakh of CRR, right? So we can utilize that. Is that clear? Because see, the ultimate, goal of CRR is what? To just issue fully paid up bonus shares. That's only utilization of CRR. Okay, and if you are issuing fully paid up bonus shares in this question, then we have to give first priority to CRR only. That's the logic. Fine. So let's see first, how much is the bonus issue over here? What is the preference share capital? Sorry, equity share capital. See, equity share capital is how much? 10,000 equity shares of 10 each. Yeah, 1 lakh. That's the capital, equity share capital. So now let's calculate the bonus. It's really simple. They are saying 1 share for every 1 share. If you have 1 share in the company, 1 additional share will be given to you for free of cost, right? So how will you calculate? Really simple. Now there are 10,000 shares in the company. So now what will happen? 100% bonus mean, additional 10,000 shares will be issued. Yeah, 10,000 shares are already there into what? 1 by 1. So that is 10,000 additional shares. So in total, how many shares will be there after the bonus? 20,000 shares. Is it clear? That's the thing. Fine. So what is the value of the bonus? That's the number of shares. 10,000 number of shares, bonus shares into value. What's the value? Value means you have to multiply with the face value into 10. It's fully paid up, right? So into 10, that's equal to 1 lakh. So additional 1 lakh capital will come into the picture. Additional 1 lakh capital will come into the picture. But now, what is the source? Did we get any money from the equity shareholders? No. Bonus means, existing reserves and surplus are being converted into equity share capital. So that means you have to convert CRR into equity share capital. Is that clear? That's the thing you have to do. So how this will happen? See, 2 entries you have to pass for bonus issuing fully paid up bonus shares. Okay, fully paid up. Let me just write here. Fully paid up bonus shares. Okay, fully paid up bonus shares, not bonus call. So the first entry is what? First entry is utilizing the reserve. When the bonus will be announced, from the accounting perspective, what will happen? Reserves will fall, okay, and then the money from reserve will be temporarily transferred to a temporary dummy account called as bonus to shareholders account. This is also an equity account. Okay, the money is being transferred over there. So you are utilizing CRR now, capital redemption reserve. So you will debit the capital redemption reserve because it has credit balance. If you are utilizing, you are taking money out of CRR, CRR is decreasing. That means you have to debit that. Capital redemption reserve account, debit 1 lakh. Money will be transferred to bonus to equity shareholders account 1 lakh. Okay, credit. And then what do you have to do? You have to increase the capital, and ultimately what should happen? Reserve should fall and capital should increase. That's what happens in bonus. So what you have to do is you have to cancel this bonus to shareholders account. Here it is credited, you will make an equal debit, bonus to shareholders account debit 1 lakh, and then you will credit ultimately the equity share capital 1 lakh. Okay, that's how you will be issuing the fully paid up bonus share. Really simple, 2 entries. Okay, CRR to bonus to shareholders account, and then bonus to shareholders account debit to equity share capital. Okay, capital is being credited, that means equity share capital has increased. Is that clear? And bonus is always issued in relation with equity shares only, okay, not preference shares. Okay, not preference shares. In this chapter, what happened in this question? In this question, in redemption of preference shares, we create CRR, and the only objective of creating CRR is to guarantee the replacement of capital, right? To guarantee the replacement of capital, section 55. So that's what happened. We can see this practically right now. See, capital redemption reserve we created over here to comply with section 55, and then the question said the company issued the bonus shares. By issuing the bonus shares, what happened? By issuing the bonus shares, this CRR got converted into equity share capital. You can see this, yeah. So capital is being replaced. CRR guarantees the replacement of capital. The free reserves are locked. Free reserves are locked in CRR. Yeah, from CRR you cannot give dividend or anything else. Okay, the only objective is to replace the capital, that is by issuing fully paid up bonus shares, and only fully paid up bonus shares. Okay, not bonus call. Bonus call cannot be done from CRR. Fine. So that's what. Simple now. So in this question, what happened? Let's just revise quickly what we did over here. See, really simple. In this question, what happened was, we had final account adjustment. We had to redraft the balance sheet. Yeah, we had to redraft the balance sheet. Why? Because we need properly what is the cash figure, right? Do we have enough cash or not? And then do we have enough reserves or not? In this question, we are also not doing fresh issue, right? So this information is very important for us. Okay, you cannot directly, debit or credit the profit and loss over here. If you do that, then you might end up, using up the profit and loss more than what it's actually there in the question. Okay, you will mess up. So that is why the ICAI has done to stay on the safe side, to make it easier for you guys, ICAI has not touched the profit and loss at all. They have only utilized the general reserve. That's how they have taken a shortcut. You can also take that shortcut, but in exam, if the question comes a bit twisted, then you are gone, right? Because you will not have command on this. Okay, redrafting and also simple. It's not difficult, yeah. It's really simple and straightforward. You just have to redraft, and then you have to follow this sequence properly. Redrafting the balance sheet, and then if there is any cash arrangement, then do the cash arrangement first. Like here, investments are sold. In some question, some other assets can be sold. Okay, and then the third thing is you have to go with the redemption. Redemption means the equation you have to do is working. Okay, 5 entries you have to pass depending upon the question, and then there might be some extra entries such as here bonus is there. So do the bonus at last. Why do the bonus at last? Because in bonus there is a sequence: CRR, SP, CR, and free reserves. That is why after doing up everything, then only you have to start with the CRR. Sometimes what can happen while doing the bonus, CRR will be less. If CRR is less, then the partial amount you have to take from SP. If SP is not there, then you have to take from CR, capital reserve realized in cash. If that is also not there, then you have to use free reserves. Okay, the sequence is there. Fine, just practice a lot of questions and it will be really easy. Okay, it's really simple. It's not difficult at all. So just take the screenshots if you want. Okay. Yeah. Don't worry, I will, upload the notes on the Telegram channel. Okay, fine. So that's it for this video. See you in the next video. Bye.